Today, I'm going to tell you the tax consequences of being affected by one of the Florida hurricanes in 2024. If you've been impacted by these storms, this information could be crucial for managing your financial recovery. Hurricanes like Ian, Helene, and Milton have caused significant damage across Florida, and the IRS has responded with several tax relief provisions to help affected individuals and businesses. Under Section 750.08a, the IRS gives affected taxpayers until May 1st of 2025 to file most tax returns, including individual, corporate, estate and trust income tax returns, partnership returns, S-corporation returns, trust returns, estate, gift returns, and a few others like nonprofits. First, the IRS has extended various tax filing and payment deadlines for those in disaster areas. Affected taxpayers now have until May 1st of 2025 to file federal, individual, and business tax returns and make tax payments. This extension applies to deadlines falling on or after August 1st, 2024, and before May 1st, 2025. This extension can provide significant relief, giving you more time to organize your finances without the pressure of immediate deadlines. So ordinarily, as you know, the IRS does grant you a 6-month extension of time to file, but they never allow you to extend the time you have to pay ordinarily. One of the few exceptions is when the area you live in is declared a federal disaster zone. To qualify for this relief, you must reside or have a business in the disaster area, which frankly includes most of the counties of Florida, if not all of Florida. The full list will be in the document link I attached in the description of the video, but pretty much if you were affected by one of the 3 hurricanes in 2024, you will be eligible for these relief provisions. Additionally, note that any relief payments you received from a government agency like FEMA are excluded from your taxable income. You are not required to report these payments as income. Second, for those affected by the disasters, the IRS is waiving fees for requesting tax transcripts or copies of tax returns from prior years. If you need to request prior year records, you would fill out either Form 4506 or 4506-T, and you would write in bold capital letters at the top of the form 3622-EM. That code tells the IRS that you were affected by the hurricanes in Florida and that you are exempt from paying the usual fees for processing these forms. Another important aspect is the ability to claim disaster-related casualty losses on your federal income tax return. You can choose to claim these losses on either your 2024 or 2023 tax return, whichever provides you the best tax benefit. This flexibility allows you to optimize your tax situation based on your individual circumstances. To claim a disaster-related casualty loss, you must follow these rules. Step 1 is you need to determine the loss amount. The amount of your loss is the lesser of the adjusted basis of your property or the decrease in fair market value due to disaster. The adjusted basis of your property is usually it's the cost basis of your home. The fair market value is basically what your price would sell for at current time. Step 2 is to subtract any insurance or other reimbursements. You must reduce the loss by any insurance or other reimbursements that you receive or expect to receive. Third, you apply the $100 rule. Subtract $100 from the total loss amount. Fourthly, you apply the 10% rule. Subtract 10% of your adjusted gross income from the total loss amount. If you have multiple casualty losses, you are allowed to combine them and then apply the $100 and 10% rules to the total amount rather than applying them separately. It is possible to end up with a taxable gain if you receive more in reimbursements than your original cost basis. This is common if you lose your house and you bought that house 10 years ago for a lot less than what it's worth when you lost it in the hurricane. Your insurance will pay out a value closer to its fair market value when the hurricane struck rather than the cost for when you originally bought the house. It is possible to end up with a taxable gain if you receive more in reimbursements than your original cost basis. In this case, your gain may not be immediately taxable so long as you replace the destroyed property within 2 years of the end of the year in which you have the gain. So that situation is very common with homes, Let's say you bought a house 10 years ago for $100,000 and 10 years later it was worth $300,000. Then the hurricane came and destroyed your house. Your insurance is going to pay out $300,000, not your $100,000 original basis. So if they pay out $300,000, basically the IRS treats that as if you sold your house and made a gain of $200,000. Now, as long as it's for residential properties, as long as you replace the destroyed property within 2 years of the end of the year in which you have the gain, that gain will not be taxed. So let's say for tax year 2024, you lost your house. You'll have until the end of year 2026 to buy replacement property. Keep in mind that it must be a similar use property. You must replace your home with another home that you will use as your main residence. For example, you can't buy a rental property or a business property and then not pay the capital gains on the involuntary sale of your main home. Now you can, let's say you had a business and you lost the business property and you had a taxable gain from insurance. You would only be allowed to buy another business property in order to not pay the capital gains tax on the insurance compensation that exceeded the basis of your property, original property. For those affected, there are also provisions for loans and early withdrawals from retirement plans. The IRS allows for a more lenient approach in accessing retirement funds to cover immediate expenses without the usual penalties. However, it's essential to understand the implications and consult with a financial advisor before taking such actions. In summary, the IRS hurricane relief provisions offer much-needed support to those affected by recent hurricanes in Florida. By extending deadlines, providing flexibility in claiming losses, and accessing retirement funds, the IRS aims to help families and businesses recover more quickly. I hope this information helps you navigate the tax relief process. If you have any questions or need further assistance, feel free to leave a comment or reach out to us at reliance-tax.com. Thank you for watching.